172,000 jobs. That's how many Americans got hired last month. More than double what Wall Street expected. Unemployment? Steady. Economy? Strong. So tell me, why did the stock market just crash? Why did the Nasdaq drop 3%? Why did NVIDIA lose 5% in a single day? Why are traders staring at their screens like they just watched their house burn down?
Here's the truth nobody's telling you straight. Good news just became the market's worst nightmare. And if you don't understand why, you're going to keep losing money every single time this happens. And this isn't new. This isn't some crazy one-time glitch. This has happened before, multiple times. January 2025, jobs came in way above expectations. S&P 500 dropped over 1.5% that same day. February 2023, 517,000 jobs added, almost triple expectations. Markets got slammed. January 2024, 353,000 jobs, double expectations. Treasury yields spiked. Stocks fell hard. October 2022, strong hiring data. Fed went full aggressive. Stocks sold off across the board. Same story, different year. There's a pattern here, and once you see it, you can never unsee it. Let me break this down like you're 10 years old. Imagine the stock market is a kid, and the Fed, that's the Federal Reserve, America's central bank, is like the parent who controls the candy supply. When the economy is weak, people losing jobs, businesses struggling, that kid runs to the parent crying. And the parent says, "Here, have some cheap candy." That cheap candy, that's low interest rates, cheap money, easy borrowing. And stocks love cheap money. But when the economy is strong, everyone's working, businesses are booming, the parent looks at that kid and says, "You don't need candy right now. You're fine." Worse, the parent might even say, "I'm taking some candy away," meaning raising interest rates, to make sure things don't get out of control. Higher rates mean borrowing gets expensive. Companies can't grow as fast. Investors move money out of stocks and into bonds. And just like that, the market drops. That's it. That's the whole game. Strong economy equals less Fed support equals higher rates equals stocks fall. Now, let's talk about what actually happened today. 172,000 jobs came in, double expectations. And immediately, Treasury yields spiked. The 10-year yield jumped above 4.54%. Why does that matter? Because when bond yields go up, growth stocks get crushed, especially tech, especially AI. Here's why. Tech companies like NVIDIA, AMD, Broadcom, their value is based on future profits, money they'll make years from now. But when interest rates go up, future money becomes worth less today. So investors reprice everything downward, fast. That's why NVIDIA dropped 5%. That's why the Nasdaq bled 3%. Not because the business got worse overnight, but because the math changed. And now, there's a new player in this story. Kevin Warsh, the new Fed chair, just took over in May 2026, and this jobs report lands right in his lap on day one. Markets were already nervous about his approach. Warsh is known as a hawk, meaning he leans toward keeping rates high or even raising them to fight inflation. And now, with 172,000 jobs, his hawks just got stronger wings. Fed Governor Christopher Waller already said it last month. "I can no longer rule out rate hikes further down the road." Rate hikes, not cuts, hikes. Coming into 2026, everyone expected rate cuts. That was the plan. That was the dream. That dream just died this morning. Markets are now pricing a 43% chance the Fed raises rates by December. Some models show over 20% chance of a half-point hike before year-end. That's a complete 180 from where we started this year. And while Wall Street traders are recalculating their models, retail investors are just watching their portfolios bleed. On X, formerly Twitter, the reactions were brutal. One number wrecked the entire market. Market just wanted a reason to turn red on Friday. Good jobs report. Economy's healthy. My portfolio's down 5%. Makes total sense. The frustration is real because on the surface, this makes zero sense.
People have jobs. Businesses are hiring. The economy is growing. And yet your 401k just took a hit. That's the cruel irony of modern markets. They don't trade on reality. They trade on expectations, on what the Fed will do next, on liquidity, on cheap money. When cheap money disappears, everything reprices. Here's what most people are missing in all this noise. Yes, the market dropped today. Yes, rate cut hopes are dead. Yes, hikes are back on the table. But zoom out for a second. 172,000 jobs is actually good news for America. People are working. Businesses are growing. That's real. The problem isn't the economy. The problem is that markets spent the last 2 years getting addicted to cheap money, low rates, easy liquidity. And now that the drug supply is getting cut off, there's withdrawal. This correction was coming. The jobs report just pulled the trigger. So, what do you do with all this? First, understand the game. When you see a strong jobs report, don't be surprised when stocks fall. Now you know why. Second, don't panic sell. This is not 2008. This is not a collapse. This is a repricing, a flush, the market adjusting to a new reality. Third, watch the Fed. The next FOMC meeting is June 10th. Whatever Warsh signals there, that's your next major market move. The market isn't broken. It's just playing a different game than most people realize. And now, you know the rules.